Hey guys, this is Nifty Alpha Trader. My name is Dilip Ray. So today I'm going to explain about basic concepts in hedging or protecting the investments. That is how options are supposed to be used as an insurance for your investments. But again, clear disclaimer that I am not a financial advisor or anything. I am just trader where I am trading and I am not a official licensed trader. So I am trading on my account and this is completely about my risk, but I am just explaining you on a basic concept of puts and options where you are protecting your investments. So this concept starts with a small thing called puts. So as you can see my screen here. So now let's start with the original idea of how a puts look. So basically you have to understand the concept of option and option chain, but ultimately there is an instrument called as puts where you can basically protect your investments, right? So whenever you have all these stock holdings, for example, I have around X number of investments, right? This works only with greater investments, but ultimately what I'm saying is if you are having X amount of investments, so you think the market is going down and it will be bearish, right? So what would I do is I would hedge the position. Hedge is a fancy word to basically say I am buying an insurance for this. So hedge can be in various levels. One of the thing is I will just buy insurance. Just think it as you are buying an insurance. So you are predicting the market is going to be bearish. That is bearish in the sense the market is going to go down and whatever your investments are going to go down. So this is why you buy or you hedge. So the actual word is basically protection or hedge. So hedge is what investors use to confuse us, but ultimately it is basically protection against our investments. So that's the ultimate goal. So what we are doing here is there are two things. One is puts and another is calls. So let's go here and see an option chain in NSE website. So in NSE option chain, right, you will see all the stuff. So this is extremely confusing. When you see a huge chart and you don't understand it, I can relate with you. Even I didn't understand this before. It is extremely hard concept even to understand for a beginner. But ultimately what you do is you go through this and you will find various things. One is there is options, which are option contracts, and then there are symbols. So here there are various. So today we'll only explore on Nifty and the expiry. So here if you're seeing Nifty, right, Nifty is a entire Nifty 50 stocks. There's an index for that, and then these are all the option chain for a particular Nifty, and then we have all these expiries for Nifty. For example, we have from 2023 June to December of 2027. That is almost 4 years from now. So if you are seeing there are huge here, but here it doesn't look, no one is purchasing those, but ultimately these are all contracts which investors buy and sell, and a trader buys and sells to basically hedge their portfolios. So that should be the main intention. Then after these two things, there is something called a strike price. Strike price is nothing but when you see a chart, right? Let's go to a Nifty chart. Okay. So when we go to Nifty 50 chart, we find a simple graph. So what usually happens is the market or NSE for here in this instance breaks these points into different things. Let's delete all the drawings here and comment out this and make it a line chart or whatever, but ultimately you get it right. This is the stock market and the price movement of stock. So if you see this option chain is basically a price point which it is at. So the particular price right now on Nifty is at, if you see here, it is at 18,800, right? So if you see, the background here is changing between both of these. That is one, it is here, it is in 18,800, that is 16 points below this. It's basically the background has changed, and here the background has changed, meaning there will be, this is a at the money strike. So these are all again confusing words for a newcomer, but ultimately for a veteran it would be extremely easy to grasp. So I'm just trying to explain that this is the present market price, and these are the insurances which you can buy and sell. So what are we going to do? So if we are seeing here, these are all instruments which we can buy, or basically, let's say a trader in a simple terms is betting on it, right? So what they will say is basically, let's say now my bet is Nifty has reached here. Let's take it as an example, and I will show you a real trade of mine and say what it's exactly used for. So what I am predicting right now, since Nifty has touched this line, right? Again, you don't have to take my trade or do anything. This is for educational purpose or entertainment purpose, not for real trading purpose. So what's happening here is I'm predicting that since it has come to a support, I'm predicting that the market has to go down or it has to break up. Now my prediction is the price is going to go down and it is not going to touch 1900. That's my prediction. Let's say that's my prediction. So I'll explain you the same chart which is here is in the Sensible tool. If you see the Sensible tool, it's the same thing. The background here and here, however this is there. The Sensible websites, sensible.com also gives the same thing. And now there are expiries which are also resembling, but whatever are the most liquid, that is whatever are being traded, that is what will be here. So now if you see here, this is completely in a background of yellow, and this is also having a yellow color. So what I am thinking is that the stock is going to go down. So I have one option, which is I will buy puts. So this here, this line, so there is a divider of strike price. So everything is a strike price. So if you see 18,800, 18,750. So I am predicting that the stock market might not touch 19, but it is going down from 19, right? So I am going to buy 1900. That is, I am going to bet that the stock is going to go up. But when is that going to go up? Within 2 days? So I don't have that clarity. When is the stock going to, or the index, not the stock, the index going to go down? So here is the expiry. So within 2 days, I don't predict it is going to happen in 2 days. Within June, I don't think might happen next 1 week. Is it July? Yes, it might be July, but is it December? By December, I think definitely yes. From my perspective, again, I'm giving just as an example, not a actual case. So what I think is the stock might not reach, that is 19, the index, Nifty index might not reach 19 within this time frame of 190 days. So 190 days are left for this. So what happens if by mistake the stock or the index, in this case index, reaches 1900? So once it reaches 1900 and it stays there for 190 days, right? What happens is, again, so if you're seeing this, there is a price decay. So this is the insurance which I'm buying. So insurance will be void after basically 190 days. That is what this means. So expiry is when is the insurance ineligible, or when is the expiry coming up. So when you take an insurance for your health, you have an expiry date of 1 year or 3 years, depending on how much time period you have fixed for it. So if any accident happens to you or your vehicle or whatever, that insurance covers it within that period. If the next day it happens, it doesn't. right? The same scenario is with here, that is, it covers this 1900 figure till December 4th, right? December 28th. This is the expiry which we are buying in. So if the stock or the index goes down, let's say if the index is falling to 1800, right, then what happens here is, here I'll just change this price. So I'm on this insurance, which is here, I'll be making, again, by when is this? So I'm predicting by December it might go down, right? So by December, if this is falling by X amount, then I will be making money on this. If it doesn't, then let's say if it remains at the same level, right, I'll be making a loss because I'm paying an insurance, right? So if you're paying an insurance and if you're buying a life insurance, what happens to that is basically, if you don't claim that, then it goes as void, and in the next renewal session you will again have to buy it. The same way this applies. So in puts, the thing is you have to buy it over time. So these are all the expiries which are available. So basically, if you want to buy, let's say, let's compare with life insurance. So do you want to buy a monthly insurance this month end, or next month, or next month, or December? That's the basic scenario of how it's going to rotate. Now that's the basics of put options. That is, it's if the price is going down. Now what's happening is, let's say in a case where you sold a stock. So I'll give you various examples which is happening in live right now, so you'll understand it in a much better fashion. So this is one way of hedging, that is, you are basically buying a put, right? You can also do one more method where you say that I already have an investment, but here the insurance is being sold by an insurance company, let's say HDFC. But in other cases, the insurance is not sold by any company but another party, which is who is also a stock market participant. So the stock market participant would be someone who thinks that, let's say, the same scenario, right? So I will sell call. This is, basically the same strike, right? There is, if I'm bearish, I will buy put or sell call. These are the two options to be bearish in a market. So what am I predicting here is, till December it will go down, right? Till December it might go down, but it might not go up by 19,000. Wow. Or 1900. 19,000 or 1900. Yeah, 19,000. Yeah. So now what's happening is, I am predicting that the market won't go down, so I am betting on this. So after, if it stays here, the same zone, what happens is, I would get the 45,000 if I remain till December 28th. That is, if it goes down, I will be making money. If it is staying in the same zone, I'll be making money. If it goes up, I'll be making losses. So let's consider selling options would be a challenging thing to understand. So selling calls is basically, you have to think from the party, that is the insurance company itself. So what does insurance company do is, basically they bet on various other associates. Like, they'll take a prediction of, let's say, 100 families, and all the 100 families might not get deceased at the same time, so they're saving a huge insurance for that particular year on that. If one gets any injury, it doesn't matter, because that huge amount corpus of all these will cover a particular patient. So the probability ratio is extremely less that everyone get deceased and their insurance is going to be bankrupt, right? So again, there is insurance for insurance. These are all other things which were diverging, but ultimately the point is, you have to consider selling calls is something which the other party is trying to do. So for example, so if I am uh, buying a puts, right, who is going to sell a puts? So here there is buying or selling, right? So I can either buy a put, which is buying an insurance, or buying an insurance over the portfolio, or selling a put, which is ins- giving other person an insurance that I will take a responsibility. Now if you're seeing who is going to do this, so the one who is going to do this is basically saying that I have a prediction that the market might not go down and it will be above this price, that is premium plus whatever premium I have collected from a particular person, plus the amount of the strike price is what I will make. So the market for him is bullish, not bearish. So whoever is selling you the puts is basically bullish, and as you're buying the puts, you're bearish. So you are buying an insurance and he's selling the insurance. That's the basic gist of it. Now the other scenario, I'll tell you what are calls. Basically this is basically selling insurance. So now I'll show you a real trade where I'll show you a real scenario what I've done here. So in this example, so I am predicting that the stock market has gone to the highs. Again, this is just a prediction. Might have taken trade, I might not have taken trade. I'm not saying others should or shouldn't. Again, I'm not an advisor, but I'm just trying to educate you. So what's happening here is basically this is a trend line, and now what happens is once this is reached, I am predicting that the market might go down, and might have a correction, and it can come down and again go up. But this is a basic trend line which I'm showing you, but there can be n number of predictions and n number of scenarios to take this. Now the entire goal is how are we protecting it. So what I'm trying to do here is, so I'll not show you the complex strategy around here, I'll just show you this single line. So what I'm doing here is I'm buying a put. I'm buying 2 lots of puts. So here in options there is a possibility that you can buy in terms of lots, that is x number of things. So let me show you what is the lot size. So in this scenario, it is in this scenario, if I exit this, so it shows me it is around 100 quantity, right? 100 quantity. And what is the stock, what is the index price right now? So I am saying 100. So this is a basic maths, but the math behind it would be much complex. So I'll just tell you this is a nominal way of calculating which I do. So into this one. So if you see this, the portfolio, so the nominal price of this has come to 18 lakhs. That is whatever puts I have bought is for 18 lakhs, right? So now if I go back to the console and if I see the amount here is 19 lakhs, right? So how much am I hedging here is actual to the actual amount, right? And so what am I predicting? That the market is going to go down and I am going to basically pledge my stocks and hedge this thing. Again, pledge is a not so complex concept, but I'll cover that later or not cover it. But ultimately what I'm doing, I'm buying puts. So right now I'm in losses, but what makes a profit is basically the stocks which you are buying it. So it might not always be the case until you are buying Nifty futures or another type of trade which you're taking on top of it. That is not a concern here, but the actual concern here is we are hedging our own portfolio, so we will make a profit if the entire Indian economy or Indian stock market or Nifty is doing bad. We can make money and protect our positions and portfolio. So you don't have to take any hasty decisions on that day that the market has fell down. So that's a core idea behind all this. So since I have taken this, what happens? Let's say if the stock, if the market is falling by 1800, right? So I will have a huge losses in my entire portfolio. But where will I make profits is I'll be making profits here. So if it falls to 1800, right? Oh, okay, no, 18,000. This is a problem with hundreds and thousands. So in 18,000, what I'll be making is ultimately I'll be making 56,000. But I'll be in the same specific day. That is, it has to if the market is falling by 4%, I'll be making 56,000 rupees as a profit. But I'll also be making losses in the stock because the entire market might also reflect the stock. So this is the hedging strategy which we are implying here. So this is again educational purposes, not any other thing. So again, if this remains, the price remains, then I'll be making up much more in this scenario. So let's take the same scenario, and once the market falls, there are other things such as Greeks, which implies what I'm trying to do. That is, delta and other things vary when the stock, if the index is falling. So if the index is falling by a greater, in a faster pace, the EV might increase, IV might increase. So IV might increase from 11 to something, let's say 15. So in this scenario, we can make more profits on the same day if that happens. But it's not up to us to predict this. This IV is predicted by change in options, selling volumes of change here, and that formula is in VIX formula. So India VIX is one of the metrics on how the IVs are calculated and how the big players fluctuate the prices of options. So that will give us a good price once the market falls. So this is basically hedging on a single stock. So now I'll go to the other example. So I have told you when to be bearish, right? So I have given you an example that I'm bearish here. So I'll go to another stock example. This is not a stock pick or whatever, but let me go here to in this scenario Ambuja Cement, but I'll just go to one of the examples of Ambuja Cement. So when I'm going here, I'll go to call options here. So here what am I trying to do is I'm trying to sorry, not this one, put options. I'm selling a put options here. Again, as I said, selling a put is basically for being bullish, right? So in this example, if you see, in this example I'm making 12,000 losses, right? But what happened here, let me put a clear example on what I'm trying to do. So in this one, I have sold my stock. Let's say I'm predicting that the stock might be available at a cheaper price and a better price, and the stock has a probability of fall. So rather than actually participating in equity, I can participate in options. So in this example, let's say I have bought Ambuja at 410 and I've sold it at 462. So I made enough profits. Now I'm predicting that Ambuja might fall a little, but the quantity is different from the lot size, mind you. So what I'm predicting is Ambuja might not be in the same price range. It has a probability of falling. So what am I doing? As I've exited the cash market and I have taken it in puts. So what I'm trying to do here is I've bought the stock not in cash and equity but in options. This is a harder part to digest for a beginner, but ultimately what I'm trying to do is I'm trying to buy Ambuja the same a different amount. So now at the same price of this one now the price is so since I have bought this one, so since I have sold, I have not bought, I have sold 160p. So it acts as a 160. So again, let's go to the chart and see the same scenario where I've sold this as an insurance. Who is a capable buyer and who is a capable seller in this case? So as I told about Nifty in this example, what am I trying to do? I am predicting that Ambuja is falling. I'm predicting that Nifty is going to fall. So that's why I have bought puts. Now in Ambuja's case, what did I do is Since I have already made money, so there are various participants. There's no single psychology to determine this, but there are various participants. So various participants will have various ways of thinking. So the psychology and what they think is completely different. So my thought process is, since I have already sold my stock, why should I participate in stocks? Rather, I'll participate in options. That is, let me eat the premium or get the premium of the stock. But even if it's falling down, I'm again ready to take it at a lower price, which is adding a premium to it. That is my mentality. So let's say in the same case here, what happened is I have sold Ambuja at 163 or something, which is somewhere at the top. I'm shocked, like what I've done. And then I have sold this puts. Right now what's happening is I am thinking that I will have this premium, this entire premium, and I will also have the stock. So at the end of the day, I'm going to have a stock. But what is my prediction? My prediction is it might fall. The Ambuja might fall, but I'm selling it and I'm buying it at the price which I've sold. So that way I'm benefiting. So the same market participant, let's say in Nifty's case, who might be selling this calls, might not have the same scenario. So who might be doing this is someone who has been long since a long time, right? So this price of this, uh, let's see the price of the same puts which I have bought, right? So I will open the chart of the puts which I have bought. So if you are seeing the puts, so the puts, if someone is a seller of these puts from 3000, he is the one who is exiting here, or he has profited from 3000 selling it at 3000, and then he has, let's say he has sold every stock here and then he has exited and he's now going to sell the thing. So ultimately it's always about different participants thinking in a different level. Not everyone doesn't do a strategy in the same way, but ultimately they can have their own game. But this is ultimately about protecting our investments, right? So there are two ways. Again, there is selling puts and selling calls. I've explained you both. That is, if you are facing a challenge in in let's say if you are feeling that your investments might go down and other things, then always right time is to have a financial advisor in the first place, and then take a advice from him, whether how does the market look, how does the macro indicators work, and what does the macro indicator say, and how will the Indian economy perform over time, and then take a call on what. And he should also be advising whether to exit in cash or to hedge or whatever, but he is the right person. So you have to have a financial advisor who will suggest you over this. I am not an authorized financial advisor, and I also am not looking forward for that, but ultimately I want to educate you on a single instrument which acts as an insurance for your portfolio, rather than being scared of when the stock market is going to fall, I don't know when to sell and when to buy. You are having a insurance which you can protect your stock from. So that's the